Question number 5 in our material, page number 12. What is the practice manual reference for this problem? Problem number 12 in practice manual. Cutoff. Say we understand that Arun is holding 3000 shares in Brown. So 3000 upon 4000 is giving 75%. Correct only, no? Then Arun is holding 400 shares in 2400 shares on there is in 400 shares in Crown. How much this works out to? 400 upon 2400, which is equal to 16.67%. Brown holds 1400 shares in Crown. How much is this quantity of shares will work out in terms of percentage? 1400 by 2400, which comes to 58 and 1/3%. Both put together in Crown 75%, and minority interest in both the cases will be 25%. Date of acquisition in both the cases being 1/7/2011, date of consolidation being 31st of December 11, prior to acquisition first 6 months period, and post acquisition second 6 months period. Okay. Then this is what we normally note it down under the head called cutoff. Shall I proceed to the next one? Then classification. Say we have two items in reserves and surplus, and we normally take up the last subsidiary Crown for our analysis. Crown was having general reserve of 30,000. Find as what was the reserves at the time when they prepared the last balance sheet? 20,000. Current year 10,000. Then first half and second half 5,000 each. 25,000 as capital profit, this being revenue reserve. Then profit and loss account, a lakh of rupees that you find in the balance sheet of Crown, and how much they have reported as existed at the year beginning? 12,000 only. Opening 12,000, current year 88,000. Normally we assume that profit is earned evenly throughout the period. first and second. This being 44,000 and 44,000. $56,000 as capital and this being revenue profit. Then we take up Brown for our analysis. General reserve 40,000 40,000 at the end, also 40,000 at the beginning. Opening figure 40,000, current year should be nil, this being capital profit, this being revenue. Nil is revenue, there is no need to divide that first and second. Then profit and loss account of 1,20,000. Here is a place where we will be doing it with a little more sharper way, as how angle bolt canopy we have just done. Firstly, we will take up dividend received from Crown, because Brown is holding 58 and 1/3% in Crown, and Arun also received, but whose reserves and surplus taken for analysis? It is only the Brown's reserves and surplus we take up for comparison. How much is that? 10% into 2,40,000 into 1,400 upon 2,400. So 0.1 into 2,40,000 into 14 divided by 24. That comes to 14,000. This 14,000 in which we will take up first half and second half. This is a portion that we have to do it the way in which we have done in the case of angle bolt and canopy. How much is that? 7,000 and 7,000. 7,000 and 7,000. This is pre-acquisition. This is post-acquisition. Then the balance amount is 106,000. Am I right? This should be the correct amount that we should have taken up. But anyway, we will just bring out further more analysis. What is opening balance? Opening balance being 20,000 negative. So current year figure should be 1,26,000 balancing figure. This shall be divided into first half and second half. 63,000 as capital and revenue. This is also capital. I mean, the figure that we have to take up as capital will be 43,000 cap, and this being revenue. Now this should also be a revenue because matter related to post acquisition. So therefore this will be pre-acquisition. So now in this case I will repeat 1,20,000, 7,000 pre-acquisition, capital profit. How much is capital profit? 43,000 capital profit, and 63 plus 7, 70,000 will be revenue profit. This is the sharpest way of bringing out classification, like how we have done in the case of angle, bolt and canopy. This is the sharpest way of bringing out the classification. So this is To be rectified. To be rectified. To be rectified. So now what will be the revised P&L account of Brown? Revised P&L account of Brown should be 1 lakh and 13,000. How come? 1,20,000 minus 7,000. Revised P&L account upon rectification. Are you clear? Now, equipment that they are talking about. Unrealized profit. Crown, from Crown transfer took place to Brown. That resulted in the difference between the two is 8,000 from Brown to Arun. 52,000. So 4,000. So the entire thing we will put it out as upstream. So we should keep this unrealized profit above the total. In our template it is to be taken above the total. That will automatically take care of how much we have to deduct from minority interest and how much we have to deduct from the respective parents. Okay. So in our institute study material they deduct some portion from some place, some portion from other place and all that. So our format will take care, and we don't have to really consciously do all this effort. Except for positioning it in the right place, the system will automatically take care. So this is as far as upstream is concerned. Now let us just take up on to pre-acquisition dividend. Pre-acquisition dividend received by Arun from Crown. %% on 2,40,000 into 6/12 into 16 and 2/3%. So 0.1 into 2,40,000 divided by 2 divided by 6. How much is that? 2,000. Received by Arun from Brown. 10% on 4 lakhs into 6/12 into 75%. How much? 15,000. Brown receipt from Crown we have already taken up for rectification. We have already reduced it from P&L account, but we have got to reduce it from investments account. That is the only item that we have got to do. Normally interim dividend is paid out of current year's profit only. There is no way interim dividend can be paid out of pre-acquisition profits, which will normally be done only out of current year's profit. Current year's profit is earned evenly throughout the period, and there too the interim dividend can also be identified as the interim dividend related to the pre-acquisition period and paid out of pre-acquisition profit, and interim dividend related to the post-acquisition period paid out of post-acquisition profit. Now we will launch our template, which we call it out as chart. It is Brown in Arun, Brown in Crown, because parent as well as subsidiary there in sub-subsidiary we are following direct method. By default we will follow direct method. DOA, DOC, RR and RP. This RR and RP, we will have some extra space because we have to provide space for parent as well as subsidiary. Because parent also is holding, besides subsidiary holding, major share in sub-subsidiary. Equity share capital, general reserve, profit and loss account, unrealized profit. 2,40,000, 30,000, 1 lakh, unrealized profit 8,000, 2,40,000, then 25,000, profit and loss account 56,000. Nil dash dash 5,000 dash dash 44,000 dash 8,000. Two 73, 70, 62, 36,000. Correct? Percentage of holding 75, 25, 16 and 2 by 3, 58 and 1 by 3, 16 and 2 by 3, 58 and 1 by 3. Net worth. Okay. Investments. Investments by Arun in Crown. Arun in Crown 60,000. Less pre-acquisition dividend. How much is that? Is it 2,000? 2,000. Right. Brown in Crown. Brown in Crown 3 lakh. Sorry, 2,08,000 less pre-acquisition dividend. How much is that we should consider as a pre-acquisition dividend? No. This is Brown in Crown. 7,000. Which we have already done at the initial stage. 7,000. So please understand this 2,000 I will deduct from here. 2 lakh and 1,000. This 7,000 we have already deducted from P&L account. Remember, from 1 lakh and 20,000 we have made it as 1 lakh and 13,000. In that chart we will not take up 1 lakh 20,000. We will take up as 1 lakh 13,000. So therefore here 7,000 I will not deduct it here. Are you understanding, all of you? Now, total cost will be 2,59,000. So this we will take it to outer column, 2,59,000. 2,59,000 minus 240,750. 18,250 is goodwill. So carry forward 18,250 goodwill, 90,500 minority interest, 833 and 4,000. Share of revenue reserve and revenue profit to be taken into Brown's analysis. Dash dash dash. How much is that? 2,917 and 21,000. Share of revenue reserve and revenue profit to be taken into Brown's analysis. Correct? Now, Arun in Brown. Arun in Brown. DOA, DOC, RR, RP. Equity share capital, how much? 4 lakhs. General reserve, 40,000. P&L account, 1,13,000. Remember, it was 1,20,000 minus 7,000. This 7,000 we have deducted with a corresponding reduction from investments. Four lakhs. General reserve 40,000. Profit and loss account. Remember our discussion on profit and loss account. So 43,000 we have taken up as capital profit, isn't it? Then unrealized profit dash 4,000 negative figure. Dash 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 dash. Sorry, share of revenue, that also we have to take up. No, we have forgotten. Share of revenue reserve dash 2,917. Share of revenue profit dash 21,000. Remember that we have to take up the 2,917 and 21,000. Is that right? Four lakh 83,000. $567. I will check up. 4 lakhs plus 40,000 plus 113 minus 4,000 plus 2,917 plus 21,000. 572. 572 917 2917 66 80 7,000. Percentage 75, 25, 75, 75. Are you clear about this flow? Net worth. Net worth 4,83,000 into 0.75. 362, 250. 572, 917 into 0.25. 143, 229, 2917 into 0.75. 2188, 87,000 into 0.75. 65250. Investments by A and B. A and B 3 lakh 60,000 less pre-acquisition dividend. How much is pre-acquisition dividend? A from 15,000. Three lakh 45,000. This would result in capital reserve. 362,250 minus 3,45,000. This would result in 17,250. Then brought forward goodwill of 18,250. Remember 90,500. Then 833. 833 and is it 4,000? Yeah. Then SFS. Here you have goodwill of all the entities. Goodwill 1,80,000. Then general reserve 80,000. Then P&L account 2 lakhs. Then CFS figure should be capital reserve, all that put together. Goodwill will be 1,81,000. Your P&L account figure will be 233,729. We have to deduct 15,000 from here. So it is 2188 plus 833 plus 80,000. 83021 65250 minus 15,000 plus 4,000 plus 2 lakhs. 254 250. 65250 minus 15,000 plus 4,000 plus 2 lakhs. 254 250. Consolidated reserves and surplus 337 271. That much only I will do. The remaining consolidation you can do it. Now we will check up with what institute is saying. Control F. Crown. Question number 11. What is the answer that they provide? So just check up 337 271, right? Then minority interest 233 729. 233 729. So then 1,81,000 goodwill. 1,81,000 goodwill. That's it.